Welcome back. Now, INEOS is never far from the headlines, from moving production of its much-heralded post-Brexit rival to the Land Rover Defender out of the UK to big deals for sports teams and sponsorship. It's a huge group, mainly owned by the Monaco-based British billionaire Sir Jim Ratcliffe, and chemicals production is its bread and butter. Well, now its energy division is buying more assets in Denmark, which will support its development of a carbon storage project there. Well, joining me now, I'm very pleased to say, is Brian Gilvary, the Executive Chairman of INEOS Energy. Brian, morning to you. What's the industrial logic behind this transaction?
Oh, look, I mean, this one's pretty straightforward, Ian. We're in a position right now. We're about the number 5 player in the North Sea in terms of independence. We have a strong operator position in the UK, a non-operator position in Norway. Denmark, we were really in an end game position where we probably had 3 or 4 years worth of runway left before we sort of start to think about decom. And the Hess deal transforms all that. I mean, the first part is it's a synergy play. So, you know, there's value up front available to us over the next 4 or 5 years as we integrate the asset, given we already own a third of it in terms of the main asset, Sidani. There are 2 growth options that come off the back of it that are already drilled out. It's a heritage Dong asset that we purchased some years ago, and both those projects are relatively well positioned to be developed. So that's Solsort and Hyra. And then the third component you talked about, which is actually carbon capture, which is great. So we've already finished phase 1 of Green Sands, which is a carbon capture project where we can take potentially up to 8 million tons of CO2 into that reservoir, set against, which represents about 80% of what the Danish government has set out by 2030 it wants to do in terms of carbon capture. So, you know, there's a sort of a sweet spot that all 3 things came together. And Hess have a clean exit. They're one of the earlier pioneers of the basin. So, yeah, no, it transforms our business in Denmark and puts us on a growth projectile, probably out to the mid-2040s.
I mean, you hinted at this just now, Brian. Obviously, Denmark wants to phase out exploration and production in the North Sea by the middle of this century. I mean, this asset presumably only has a limited shelf life.
Yeah, look, I mean, you know, in some respects, Denmark is a great place to do business in that it's already set a cessation of production of 2050. We know there's no more exploration. That's not really what we're looking at. We're not looking at wildcat exploration. We're going to be working off existing fields and infrastructure. And we all know as part of the energy transition, we're still going to need more oil. And Denmark knows that. And therefore, it's sort of set a timetable for us to run these assets down. Now, you know, the life of these fields is probably out max 2045, which is 5 years before cessation of production. So I think the key thing here is we can meet the energy transition requirements in terms of oil, but at the same time, alongside that, we'll be developing a carbon capture project to demonstrate how we can deal with the CO2 associated with fossil fuels and put that CO2 back into the ground.
It's a very interesting mixture of businesses you've got in INEOS Energy. I mean, you've got conventional hydrocarbon businesses and these low-carbon technologies. I mean, can the 2 sit comfortably side by side?
Yeah, no, look, I mean, INEOS is an extraordinary company. It's a massive multinational, and all of the things in your studio right now have probably come from an INEOS process. If you just look at all the things around you from a chemical perspective, we are also one of the largest producers of hydrogen, grey hydrogen, in Europe today. We produce 300,000 tons of hydrogen. We've just announced actually this week that INEOS, through our subsidiary Innovin, will build its first green hydrogen plant around the Norway Rafnes location that we've got, and that'll be about a 20 megawatt green hydrogen plant. Now, hydrogen will be a big part, I think, of the long-term solution in terms of the energy transition, but it's probably 10 to 15 years away before it becomes economic. As we move in towards hydrogen-based solutions, we're going to need grey hydrogen as part of that transition. So, look, you know, INEOS is going to play in this energy transition in any number of ways, whether it be at the fossil fuel end, which is what today's deal was all about, or whether it's about the future, which will be hydrogen and potentially carbon capture as well. So, yeah, no, look, you're going to see us across the piece in any number of different facets of the energy transition.
And how do you judge right now, Brian, the supply and demand dynamics for crude?
Oh, look, I mean, you know, you would have seen all the action yesterday. I sort of looked through, you know, 35 years in this industry. I think the average oil price has been around 45, 50 bucks, which is always a good medium. I remember learning from a chap called Lord John Brown that, you know, 45 to 50 is a good medium for the economy because it encourages growth. And it's also a good sort of number in terms of delivering returns. We saw a massive hike off the back of the OPEC announcement a week or so ago, where they said, look, they're going to keep production off the market. I think the big, you know, what we've seen is with oil prices coming up to sort of close to $70, and I think they breached 70 at one point from the super lows of last year in the middle of COVID. we have to remember that actually OPEC is keeping supply off the market, and there's still 5.5 million barrels a day that they can bring back on the market. So therefore, it's not surprising that when the market starts to see some negative data, but this is a really tough one. There's this thing about signal to noise. There is a huge amount of noise around the fundamentals. For me, the key thing I look at is the absolute stock levels, and absolute stock levels around the world have come back inside the 5-year average. So that just means oil is now well underpinned, and it would appear OPEC and OPEC Plus want to try and keep the oil prices around this level. So, I mean, I think somewhere between 55 to 65 is probably where we're going to see it trade. You may see some spikes. I don't think you see a lot go a lot below that unless OPEC releases control in terms of how they bring those 5.5 million barrels a day back on the market.
All right, Brian, it's always good to talk to you. Really appreciate you joining us today. Thank you.
Great. Thanks, Ian.